An initial public offering, or IPO, is how a private company becomes a public one. Let's break down how this process works for everyday investors. IPO stands for Initial Public Offering. It is the first time a company offers shares of its stock to the general public on a stock exchange. Before an IPO, a company is private, held by founders and early investors. An IPO shifts that ownership structure to the open market. Companies go public primarily to raise money for growth, allow early backers to sell their stakes, and gain prestige in the market. Public companies face much stricter rules than private ones, including regular financial disclosures to regulators like the Securities and Exchange Commission. The journey to an IPO takes months. It involves intense preparation, regulatory filings, and a roadshow to gauge interest from large institutional investors. Remember that the initial price is often determined by institutional demand, which can lead to significant price movement once trading actually begins. Understanding IPOs helps you navigate the market with more confidence. Thanks for watching, and remember that this is educational content, not financial advice.